All right, time now for your bond update. The U.S. got a better than expected jobs report on Friday, but the message from bond markets is still rather gloomy. For more, let's head over to Lisa Abramowicz. Lisa?
Thank you so much, Romaine. It seems to be a key question right now in markets. Are the ultra-low yields that we're seeing in developed market bond markets compatible with strong demand for risky assets? If you take a look at a number of metrics currently in debt markets, it seems to suggest perhaps not so much, at least in the medium to longer term. Take a look here. This is the gap between 3-month and 10-year Treasury yields. It's been inverted for about a month and a half. This is a gauge that even the Federal Reserve itself looks at to foretell recession, although it can be a sort of leading indicator giving more than a year before there actually is a downturn. But flip up the boards and take a look now at the gap between 2-year and 10-year Treasury yields. This is also a key metric, in particular for banks and earnings there, but also an indicator of recession. And it's now about the narrowest since going back to 2007, with less than 0.2 of a percentage point separating the two here. Just to give you a sense, that means that basically you get the same yield on 2-year and 10-year Treasury yields. And then the question is this because investors are saying, well, the Federal Reserve may not cut rates all that much given the good report that we got on Friday? The answer is not so much. Right now, markets are still expecting about 2.5 rate cuts by the end of this year. So the Fed's still priced in as accommodative, and yet those yield curves are telling you longer-term growth prospects seem to be dimming, which typically does not bode well for risk assets. So some things to think about right now as we head into a second half as U.S. equity markets are at or near their record highs.